Good morning, everyone, and welcome today to Tax Hacks 2020 on a Saturday morning. We are here to help you on how to save maximum taxes with all possible options available to you. And as we are nearing the tax season, most of us will have a deadline coming towards December and January, wherein we have to submit our investment proofs. And that's where we come to help you and how you can save taxes as much as possible, which is not only a tax saving option, but also a wealth creation avenue for you. So today we have two esteemed guests on our panel. Ms. Lisa Pallavi Barbora. She is the founder of financial management, personal financial management website called moneypuzzle.in. Good morning, Pallavi, and welcome.
Hi, good
And
morning.
we have Mr. Dipen Sheth. He is our head of equities and
Hi.
strategic marketing. Good morning. Welcome on the workshop. And with this, I hand it over to you and we start with today's webinar on Tax Hacks 2020.
All right. So thank you, Pratibha. And a warm welcome on behalf of HDFC Securities to everybody who's logged in, everybody who should be logged in. We hope to see more people coming in soon. We've got quite a few people online already. And obviously, warm welcome for Lisa as well. Thank you, Lisa, for landing up today. Thank you for co-hosting and participating and indeed discovering how to become a tax hack over the course of the next 1 hour. I think the most important thing that I would like to start off this interaction with is the fact that taxes are not just undesirable, inconvenient, and painful things that we have to incur throughout the year and particularly plan for them at the end of the year, but they offer us, the policy framework of the government offers us an opportunity to save taxes sensibly depending on where we are in our life cycle and our career cycle, and to then sustainably create wealth out of that, create a little nest egg. Most tax saving options enable us to create long-term savings and investment options, avenues that help us create a nest egg for later use when we are going to get retired. A lot of you guys out there are like 20 something or 30 something, and retirement just looks like one fuzzy thing in the distant past, in the distant future. That shouldn't really occupy too much of your time, but you'll be surprised at how much better your retirement can be if you get a head start on this activity and with minimal pain and very efficiently managed allocations over the years. So Lisa, any thoughts on that before we kind of kick off the presentation? Any opening thoughts, remarks?
So you're absolutely right. Thanks for having me here. It's a pleasure. And you're right in saying that, the nudges that are built into our IT Act, the ATC, for investing and tax saving are so good, actually, for somebody who's starting out in their early 20s. Even my very first investment really was a tax saving investment. But I think now it's so much easier. At that time, we were still filling forms and doing all the work like that. But now it's just a click of a button. And if one doesn't start early, and we'll probably explore that by and by as we talk in today, there is a lot to lose. So this tagline that you all have, don't just save tax, create wealth, that's so appropriate when one is thinking about tax saving investments, really.
Super. Okay, Pratibha, let's move forward. Right. All right. So I think the biggest thing that distinguishes the tax hacks from normal human beings is that they don't look for discounts on Amazon for today or the Diwali bumper and so on. They think in time frames, and those time frames are typically medium to long term. And you will see that the red outlines on the two middle boxes, the medium. So what do we mean? Medium and long term are again fuzzy things. So the tax hacks typically choose options that give them wealth creation opportunities by saving taxes in the short term, but which create wealth for use over the medium term to the long term. So as you can see, where do you really need money? On a day-to-day basis, you need money for house rent or food and entertainment and clothing and lifestyle and all that. But if you just up that, so that's your daily run-of-the-mill spends, right? That's your consumption spend. But over a period of time, you have irregular lumpy spends in the short term, such as you need to buy a car or go on a vacation. You've taken debt to buy that car, or debt for something else, a personal loan, credit card, whatever. So you need to repay debt, you need to repair your home, and so on. So that's the typical 3 to 5 year kind of spend. In the medium term, which is where the tax hacking becomes useful, 7 to 15 years, you will actually buy a home and need to give a down payment on that. It could also be in the short term, but for most people who are young, this is what happens. Somewhere between 5 actually to 15 years, they get ambitious about buying a house. So 5 years from now, you might need some money for a down payment. Somebody who's 30, 32 will end up having a child who will need some college education, in another 10 or 12 years. So at that point of time, your child is 5 today or 7 today, and you don't really worry about college education bills then. And trust me, college education is costly even in this country now, not just overseas. Otherwise, you can settle for those colleges which don't carry any value. So you might need that education. Your second child will have certain expenses when he or she is born. And of course, in the middle of our lives, in the middle of our careers, there is always some or other uncle or nephew or niece or cousin who needs some support, or maybe your own family needs that support, your parents need support, and so on. So you might have family support needs. These things play out from 7 to 15 years. Lisa, how about the long term? You want to take that bit?
Yeah, so I think that's that's quite the most important, because if you give your investment say 15 years, and in the long term you're looking at a lot of expenses, and right now it's very hard to put a number on those expenses. So
Right.
what you want to do is just save what you can, but also you want to pick a way to grow that saving in the most efficient possible way so that it returns the maximum. Because you really, sitting today is very difficult. I mean, we can do the numbers, but sometimes you can't visualize so much. You're just putting the numbers, but you're not able to visualize how much exactly you'll need for your retirement corpus. And actually,
Right.
15 years later, your lifestyle would have changed from what you are right now, and you will really want to maintain that lifestyle, not what you're doing now. So we keep planning for this, but the visibility is slightly blurred in terms of the actual number. So
Yeah, I mean, just
paying
look
a
at
lot
the
of
items.
attention to
Sorry.
sorry.
So just look at the items there. I mean, you can't predict
Yeah.
when your child is going to get married, when you might want to retire. Some people want to retire at 48, some people want to retire at 58, and some people don't want to retire at all. Some people want to start up money for capital, at age 40. Some people don't even need it till age 60. You also need to live well as you grow older, right?
Yeah.
So there's a whole lot of things that can't be quantified, but you do need to build long-term savings for that. And it's not just savings, but you need to find a route to compounding very well. We'll come to compounding in a bit. And of course, there's always the odd emergency where you suddenly need some money for a medical emergency. You've lost a job, there's a calamity, there's something like COVID that comes up, you lose a job because of that, or some emergency spend around COVID. Families and friends always run into emergencies and so on, right? So, but the big focus for this slide is that tax hacks will think about all the uncertainties and fuzzy things around the medium, long term, and even emergency requirements, though they don't always come to everyone. There's no escaping the medium term and long term requirements, though. Okay, if you're lucky, you might avoid the emergencies. So what do they do? What do these tax hacks do? And that's the subject of the next slide. Right. So this is the toolkit. If there is one slide which is, you should, do a screenshot of, it is this one. There are 20 ways to save taxes. There are 40 laws under which you can save taxes. I'm not a chartered accountant. I'm just a simple engineer. Okay. But the super 7, if I can call them that, these are the ones. And you can see that item number 7 is bold and underlined. We'll come to that. But so you can put money into mutual funds. There is a special thing called an equity linked savings scheme kind of mutual fund. Then there is a tax saver FD. You can save some tax by buying health insurance. So this is indirect savings, but you buy protection in return. So instead of spending a very large amount of money when there's a health problem, you will end up just having spent on the premium. That's what protection is all about. You pay a small amount to insure yourself. Okay. Similarly for life insurance. Now, life insurance and particularly ULIPs, of course, there is term insurance, but most people prefer, though I don't know why, I think term insurance is the best, which just gives you indirect savings and protection. But for those who want to go through the ULIPs or traditional endowment products, you get some savings, some return on those savings, and protection as well. ULIPs are actually a very good way to build up savings using life insurance. And of course, all of us contribute to employees' provident fund, which our employer makes an unpleasant deduction of every month, which we don't like, but which is going to help us eventually. Some of us have opened public provident fund or PPF accounts. And of course, there is the national pension system, which is probably the most powerful and potent tool for the tax hacks, and sad to say in our country is the least utilized. We'll come to that in the following slides. Now, each of these products invests into these 5 kinds of asset classes. Okay. And the risk and the reward varies from asset class to asset class. So you can choose what flavor you want. Some of these, for example, a tax saving FD is simply a bank deposit. You cannot have a tax saving FD going into equity or government debt, for example. But these are the 5 asset classes into which all of these 7 can be put into, right? Lisa, your thoughts on the asset class bit?
So one thing I'll say before that is that, a health insurance and a life insurance, the protection part of it is extremely important. And it's a bonus for us that we get a tax break as well. So one has to think about it, because it helps you, like Dipen was saying, it helps you save more as well, because you're not using your savings up for a medical emergency or something. So, that's extremely important. We are so lucky we get a tax break on that as well. And so different asset classes, thankfully, we have these products that cover all asset classes, and different asset classes will have a different kind of utility in everybody's life. And while something like an equity asset class and the different products that cater to it will help with that long-term bucket that we saw in the previous slide, your fixed deposit can help you bring in a little bit of that cushion and stability, say for the medium term if you need to. So each of these has a role to play, and at the end of the day, what one chooses will depend on the life stage you're in and what you prefer.
Yep. Okay, Pratibha, let's move forward. We've seen the toolkit. Now what? Right. So this is a little bit of, this is where it gets a little complicated, and I want you guys to pay good attention here. So what happened in the budget 2021 was that now, instead of having a tax regime, now we have 2 tax regimes. Literally, do you want to go down route A or route B? And you are allowed to change the route, but not so easily and not so often. Okay. So the old regime, it's for the tax hacks. Okay. The new regime, no hacking possible, straightforward, lower rates. Figure out if you want to go there. We'll straight away give you a rate cut, but then no fooling around with policy, no taking advantage of clauses, and so on and so forth. So we've actually compared, the old rates of tax with the new rates for the annual income ranges. Okay, so up to 5 lakhs, there's no difference at all on annual incomes. But when you get to 5 to 7.5 lakhs, in fact, all the way from 5 to 10 lakhs, you were taxed at 20% in the old regime, and you can take advantage of tax breaks. Here, there's no tax breaks, so you immediately come down to 10% for the first halfway up to 7.5 lakhs, and then 7.5 to 10, you're still at 15% versus 20%. Okay, so figure out. But if you want to hack your taxes, see, the new rates I think are important for people who really don't want to hack, don't want to build a nest egg for the long term, and who are saying, I want a simple 5-minute tax return to file. I don't want complications. I want all my money available to me all the time. I don't want to put something into a long-term nest egg. If you are that way, fine. We do believe that up to 15 lakhs, you can go all the way down to 25% instead of 30. And of course, in the earlier slabs, you've got an even better discount. If that's what you want to choose, fine. But if you want to be a tax hack, well, you can reduce your taxes with, let's say, job-related expenses such as transport, mobiles, food, etc. On your medical insurance, which is the well-being spend. Certain expenses like house rent and education are tax deductible. Education spends, donations, home loans, all of that. So I put the stars because conditions apply, so to say, and there's fine print. We don't want to get bogged down in the fine print. Then the two bold items in that list on the left: short and medium term savings, ELSS, FD, NSC. These were the things in the toolkit, remember, in the last slide. And then of course the long term savings products. Then you have a little bit of cash vouchers and all that. I think we've done a lot of fudging around with our tax outgoes based on that. But the two big things there, Lisa: short and medium term savings and long term savings. Again, the message around personal finance, which is what your business is also, personal finance advisory. Save money. Don't be in a hurry to spend it. You are young. You've got a long way to compound. Yeah.
Absolutely. So my view on this new regime is very clear. I feel the tax hacks which were available in the old regime really do work. And like I said, my first investment was a tax saving investment, and it was in that long-term savings bucket. So, had the tax nudge not been there, would I have done it? I'm not so sure. I might have just spent the money. And that sort of little bit of temptation to just spend that extra cash that the new regime sort of gives us will always be there. And if the numbers also show that if you take the basic advantage in the old regime of the basic tax hack that's available, that the policy offers you, then your tax saving is actually higher than what is in the new regime under the new rates. So really, you're investing and you're saving more tax under the old regime. So my view on this is that you have to maximize both, right? You have to maximize your wealth creation and you have to maximize your tax saving. And the old regime kind of allows us to do that in a very sort of subtle way, telling us, okay, do this, do that. The new regime says, you're on your own, you decide what you want to do. Of course, you can take all that tax saving and invest it for long-term wealth creation, but we are human, and that tendency to say, chalo, let me just spend 50% and I'll invest 50% if at all, that is there. And that's a little bit in the early years, one needs to focus a little bit more on that wealth creation.
Yeah, very interesting point. So most of us are wired to enjoy and live life in the present, especially when we are young. Old age and long term looks like funny things, and you have all kinds of smart responses like, in the long term you and I are going to be dead. But the fact is that in the long term you and I are going to need serious money, and we may not be having that kind of money making job in our hands. And it's always wise to save for a rainy day, and we all are going to go through rainy days. We may not believe this when we are young. So when we get into the savings habit early on in life, it's typically because we are given the temptation, hey, if you save, you can get tax breaks. And that's a good way to get wired into becoming a tax hack. All right, Pratibha, fair point. So I will certainly choose the old regime.
Yeah, so in a nutshell, I would say that though we have a new tax regime in place, we should always consider going with the older regime, because it inculcates that savings habit in you, so that you save for a longer duration, create a wealth over a period of time.
Yeah, agree. Let's move forward. All right, so now we're going to go through each of those tax hacking tools. So at a glance, now we'll have to run through these things a little bit. The presentation is going to be available and be made available for every participant in any case. So we'll run through a little faster on this than we will with some of the other slides. So the equity-linked saving schemes, the ELSS, you can choose a mutual fund, so to say, and they put up to 80% in equity. Of course, it's a mutual fund, it's subject to market risk. Amongst all the other tax saving instruments, this has the shortest lock-in period. If you're very, very finicky about, yeah, I need access to my money. But the thing is that at least for 3 years, it's going to prevent you from making a jittery exit just because markets fell, let's say in April or March end, and you saw the magnificent pullback after that. So anybody who panicked and sold at the end of March or early April looks like a fool today, and the market keeps going through these cycles, trust me. Okay, so anyway, the details are that all the invested amounts here come under the ATC, section ATC umbrella, 1.5 lakhs per annum. And even on redemption, this is the beauty of this particular product, that profits on redemption of up to 1 lakh per annum are tax free. This is a lesser known and lucrative aspect. Okay, So ELSS is in the EEE category, exempt when you invest, exempt when dividends or whatever income accrues to you, and of course exempt on redemption. Quick thoughts here, Lisa?
So it works well for your, that long-term bucket. It gives you a good inflation plus return, which is what we need for wealth creation. At the same time, it lets you utilize that tax hack to its, within the ATC to as much as you can.
Right.
So in that sense, it's a good thing. The only drawback, like I feel, is that 3-year lock-in. What happens is that people consider it like after 3 years we must sell or change or something, which you don't need to. So I think that one needs to talk about a little bit, because what happens is one feels it's a 3-year lock-in. Chalo, lock-in khul gaya, let's just maybe change the scheme or but actually you're in a good scheme, and what you're doing is your tax saving is for the long-term bucket, where I think you put down 10 to 15 years or 15 years and above. So one has to keep that in mind. And even if your lock-in is over, there is no reason, I mean, unless the fund is not doing well or something like that, there's really no reason to withdraw. And you can keep investing every year. You can invest small amounts. Those are things which are useful for this ELSS kind of investment.
Fair enough. Fair enough. Okay, Pratibha. So that's ELSS for you. Next. Not changing. Do you have a problem, Pratibha? We'll give you a minute.
I have changed
I
it.
think
It's
something's wrong with Pratibha's
taxing
end.
fixed deposits.
So try again. Otherwise, maybe Shyam can help you.
Are you able to see tax saving fixed deposits? Are you able to hear me?
No, yes, we are able to hear you, but the tax saving FDs are not visible. Maybe, okay. So just give the system a minute to get this right. Yeah, so move forward and now maximize. Yeah. Okay. Yeah, next. Yeah, there we are. Okay. So a tax saving FD is a simple product, it's guaranteed contractually by the bank. You will get the ATC clubbing here. So in the debt instruments for the ATC benefit, the ELSS is an equity instrument. On the debt instruments, this has got the shortest lock-in of 5 years. You can get monthly, quarterly interest payout, but the interest is taxable. And then TDS will apply and all the usual stuff. This is a very low-tech product, but some people do prefer this because the money is in the bank. I don't need to worry about it. Okay, so I don't think too many people use this, but the people who are completely inclined to be hassle-free in their tax planning will avail of this. I don't think the young people who are anyway paying much of their EPF money as part of their ATC contribution would find this interesting. They might rather go to ELSS, right? So we'll jump to the next one. Health insurance. Yes, Lisa, this is where your contributions are going to be, your comments are going to be very valuable. We think of insurance premiums as expenses. I think it's a hafta that you're giving to God, to take care of you.
So I feel that, like I said earlier, that one needs to, get a hold of this first and then move on. And of course, we work in organizations which cover health, but it always helps to have that, maybe another medical insurance policy yourself, because it's a changing world. We keep changing our jobs and, things like that. So if you have that cover, firstly, it keeps you anxiety free. Kuch bhi hua, if there is a big accident or something, and these are unpredictable things, then you at least have for your family, which includes, by the way, your elderly parents, and if you have children, your children as well. And these days, the structures of medical insurance policies are so good. There are these family floaters which can cover, and you get a tax break. I mean, it's a no-brainer, really. And I have spoken to people who have, who have been very successful in their life, but this somehow gets missed. And somebody I know, her daughter got a sudden appendix, and daughter 6 years old. So don't think it can't happen. Got a sudden appendix issue, and her appendix was about to burst. and they had to rush to hospital. Sorry, I'm getting into a story, but I just want to emphasize the importance of this. So they had to rush her to hospital, and immediate surgery, which cost them about 3.5 lakhs, 4 lakhs. They didn't have Mediclaim.
Man.
So that immediate out-of-pocket expense, which is going out of your maybe long-term saving, maybe your travel pool that you have put in, maybe your down payment, whatever. And this doesn't cost. It costs, the cost for medical insurance is so reasonable that there is no excuse now to not have it. You have a tax break, it's well priced.
Yeah. So I think it's funny that we should even get a tax break for doing something that we should be doing anyway. This is like charity. We should immediately pounce on it with both hands. And in fact, you can take up the deduction from your taxable income to 50,000 if you also include senior citizens in the cover. So this is absurd. Okay, so this is a given. This is a no-brainer. That's the term you used, Lisa, and I completely agree with you. All right, Pratibha, what other tax hacking instrument is available in that list of ours? Life insurance. And
I want to add a small thing over here on health insurance there. That even though we have a cover from our employer, we also have an option to take top-ups, which are available with majority of all the service providers out there. So we should look at taking an advantage from there also, because even that gives you a tax break.
Yeah. Right. So on life insurance, I think it's a must for every family. It's another no-brainer like health insurance. And term, of course, gives you pure protection. You don't get your money back. An endowment plan gives you protection plus savings. So you will get some guaranteed returns out of it, sometimes with some bonuses, depending on some good outcomes. And a ULIP gives you protection plus savings, but it gives you market-linked returns. There's a more modern format for an endowment plan, and it's called a unit-linked insurance plan. Life insurance is much cheaper to start when you are young, so you should start early. And of course, you get the 1.5 lakh umbrella to avail of this. Now, given the way compensation structures are moving, and especially the way they rise rapidly for young people, most of us have already exhausted our 1.5 lakh ATC umbrella by the time we are 30 or something. And I'm actually talking about the not so successful folks. Many people exhausted by age 26. So a lot of us in the corporate world are saying, okay, so the ATC umbrella is exhausted. I've put my money into life insurance, ELSS or whatever, and my EPF anyway, my deduction is almost a lakh or whatever it might be. So why should I save any more taxes? But even if you're not saving incremental taxes, buy that damn life insurance. Don't do it for just the tax saving. It's very important. It's just like health insurance, right? That's my message. If you have a counter view here, Lisa, we are happy to take it.
No, not at all. Not at all. I feel that you're absolutely right. A term policy is the most efficient way to protect. And I wouldn't go with the endowments kind of thing, because there your tax happens, but your wealth creation takes a step back. So I wouldn't go with that. ULIP you can, of course, but there are other inflexibilities. You can't do a ULIP every year, for example, for a tax saving, because every year then you're going through a medical, mortality charges, so it becomes a little inefficient. But you can once or twice, whatever. It is a good long-term wealth creation platform, at least that way. But definitely term, yes.
Yes, sorry.
No, that's it.
Okay, Pratibha. So life insurance, another must. You really don't have to club it in the tax break or tax hack category. We brought it here because it's so necessary, and it's ignored and neglected very often. Okay, Pratibha, next slide. So are you stuck on the slides again? No. So here we are. All right. So PPF, EPF, we know this bit, right? PPF, you start on your own. I'm told you can do that now with HDFC Bank as well. But EPF is what comes through as a deduction on your payslip. So again, all of these come under the 1.5 lakhs umbrella. My 1.5 lakhs ATC umbrella gets used up, but I still have a PPF account in which I religiously put the maximum amount of investing that you can do every year. I think it's 1.5 lakhs, but I'm not sure. So yeah, again, this is tax-free income also, triple E category. So is the EPF. It's completely tax-free, and you get it back once you retire. PPF you get back every 15 years. Please do this. These two are the dumbest products there are, and they're passive products. You just have to put away some money. Your employer puts away money into the EPF for you, and PPF you must make that contribution every year. Don't forget to do this. Interest rates on these products are still much higher than what you can get on FDs right now, and they compound silently in the background. I'll tell you a little bit of a story on compounding if we have time left here. Compounding is astounding when it plays out over 20-30 years. Astounding.
Yeah, so what works for EPF, of course, is great because that happens automatically and one doesn't need to think about it.
Right.
And actually 10 years, I mean, you might feel like you were saying that, it's going out of my salary right now and I'm getting less, but 10, 15 years later, when you see your EPF balance, you'll be pleasantly surprised that where did this money come from? Yeah, so that works. PPF, what works for it is that 15-year lock-in, which, like I was saying, in ELSS doesn't have that. So that temptation is there. But in PPF, that it's locked in. So, and rates change. So, once the interest rate regime starts looking up, you'll have a higher rate. But what really works is the interest is tax-free. Whatever you are earning from the PPF, it's all tax-free, unlike your fixed deposits, for example.
Right. Okay, Pratibha. But these are classic, long-term products. They fall into the 7 to 15-year, 20-year category and all of that. And the beauty of over long term is that even if the interest rate goes down a bit, the compounding impact is going to show through. Very there is non-linearity in compounding. But anyways, okay, Pratibha, next slide. So this is the least known and the most powerful weapon for tax hacks. This is the least implemented. This is the least known. Can you believe it? It's a huge hidden gem out there for tax hacks. So one, you have long-term accumulation and compounding till age 60. You started at age 25, buddy, you've got 35 years of compounding possible. And let me tell you, 35 years of compounding is not just 2x 17 years of compounding. It's way more. You'll be surprised. Do the math. Okay. It has got huge and it has got exclusive tax benefits. Nothing else gives you the size and the scope of those tax benefits which are available under NPS. We'll come to these things. It's very low cost. Managing those funds for you happens over 20-30 years. For 1 BIP, 0.01% asset management fee across all asset classes. Beat that, you buy a mutual fund, you're paying more than 200 bips for equity mutual funds, right? Sometimes you're paying more than 50-60 bips for even the index funds. You're paying 70-80 bips for income funds. You're paying 1 bip, and this achieves pretty much comparable results for you. No wonder the AMCs are not publicizing NPS. Okay, it's very tax efficient, and even on maturity, it's very tax efficient. Okay, so it's triple E up to 60%. So when you withdraw the money at the age of 60, you will get 60% in hand of your entire corpus, which has grown and grown and grown and grown. Okay, and 40% gets converted into an annuity, which you will need beyond 60 anyway. You don't want all the money on day one in any case. And there are many ways in which you can structure the annuity. And of course, during the tenure of your own voluntary contribution, you can take out 25%. So it's not that it's totally illiquid all the way up to 60. Then, boss, I don't like equity, I don't like debt, and my mood keeps changing every 2 years. Hey, you know what? You can do 75-25 in equity to debt. Or you can go all the way from 25% in debt, you can go all the way up to 100% in debt if you want to. This can be changed. I think you can change this every year, Pratibha.
Twice in a financial year.
Sorry, we lost you there. Can you come in?
Twice in a financial year.
My God, twice in a year. No. We are not schizophrenics. We will have more, fixed views on this. I don't think over 2 or 3 years people change their minds about, hey, make that to all equity or all debt. No. Anyway, you can't go beyond 75 in equity here, right, Pratibha? Right. And decent returns so far. You'll be surprised. Compare their returns with some of the mutual funds. So let's say in the equity fund category, if you look at recent returns, Nifty's given 7% over the last 5 years or so. Of course, Nifty's run up a bit since we made this slide. Okay, but 7.8% for the equity fund in NPS. The corporate bond fund has given, hey, 9.5, and government bond fund has given 10% over the last 5 years with falling interest rates. Crazy. Okay. Just the structure of the product. We'll come to the tax efficiency and the size of the tax savings and hacking that you can do. But just the structure, the product description. Lisa, I think this is the single most beautiful product here.
The product, like you rightly said, has been built for the purpose of helping people save for the long term, and it's low cost, and it's locked in. Those are the right kind of nudges for people to choose a long-term wealth creation product, and it has the tax benefits. So like you were saying, the structure is made perfectly well.
Right.
Plus you have the choice. There's a choice built in, depending on whether you want bond or equity, whatever you like. The one thing, and maybe Pratibha can add in at this point, like is the options in NPS revolve around individual contributions and corporate contributions, and I think that's where that's where also the advantages come in for this product.
So we'll come to the details in a bit. Yeah, Pratibha, bolo.
Yeah. So any person, if he or she is a corporate subscriber, they still have an option to make their voluntary contributions and take additional tax benefits. So voluntary contribution is an option which is available to everyone, irrespective of whichever category they fall into of NPS account. So I'll change the slide now.
Yeah.
Next one.
Yes. Yeah. So now this is the slide.
Right.
Okay, and this is what completely blows all other tax hacking products out of the window. Okay, and you will look at the first row has a single star, the second row has 2 stars, the third row is what we all know about, and I don't need to teach you that. Okay, so the voluntary contribution within ATC under NPS. So your voluntary contribution, of course, you will get so you will get a tax deduction up to 10% of salary. So you can put that money into NPS and all of that. So the cap, of course, there is that 10% of salary up to 1.5 lakhs, and even as other things are jostling for that space. So we've gone through this agony in some of our earlier discussion that, listen, I'm using up that 1.5 lakhs anyway through so many other things, whether it's ELSS, whether it's EPF, PPF, blah, 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 blah. Okay, so this is actually incremental. Now let's look at the first row. Okay, so there is a section 80CCD1B. Okay, any NPS contribution even beyond the 1.5 lakhs. Okay, you can take it up all the way to another 50,000 and take it up to 2 lakhs. So you can get a 50,000 deduction from your taxable income, right? By taking the NPS contribution, go and break through the 1.5 lakh ceiling, which is available under ATC. And so let's say your ATC contributions are like 1.2 lakhs or something. So 30,000 more can come from NPS, and then another 50,000 can come from NPS, right, Pratibha?
Yes, sir, absolutely.
And no other product gives you
over
this.
and above ATC. No.
Yeah, and no other product which is there in ATC gives you this. So while NPS can be used as ammunition in the ATC headroom, it can be used for another 50,000 beyond the ATC headroom. And you've gone up to 2 lakhs of tax deduction, or 2 lakhs of deduction from your taxable income, sorry, right? And then guess what? You can take this 2 lakhs all the way up to 7.5 lakhs. And only with the ammunition that NPS gives you. So that's middle row, the 2-star row, is where we are talking about now. Okay, you can tell your employer to contribute over and above the ATC number, and you can take it up all the way to 7.5 lakhs. So you're at 2 lakhs, you can put in another 5.5 lakhs, but the condition is that the employer contribution to EPF, the employer provident fund, plus the NPS contribution, plus the superannuation. Some companies have it, many companies don't. So all that should add up to 7.5 lakhs, up to. So let's say your employer contribution to EPF is 1 lakh, the superannuation is 25,000. But hey, you can take up the rest, you can fill up with NPS, and you can take this up, so that headroom which is available from 2 lakhs to 7.5 lakhs, that 5.5 lakh headroom, if superannuation is, let's say, 25,000, and the employer contribution to EPF, which has already gotten in the earlier calculation, is, let's say, 1 lakh. So barring that 1,25,000 from this 5.5 lakhs, you can go all the way up to another 4.25 lakhs and fill that up with, talk to your employer and say, deduct this money over the next 3 months and put it into my my NPS account. And with that additional, from 1.5, 50,000, and then another 5.5 lakhs. So you've added 6 lakhs of contribution, which only NPS allows you to do. And if you're at 30% tax rate, let's say, or 33% tax rate with surcharge and all of that, then you've saved 2 lakhs to begin with by promising, okay, I don't want that 6 lakhs in cash. If I was getting that 6 lakhs, I would anyway get it as 4 lakhs, right? Because 2 lakhs would go away in taxes. Now, instead of those, I forego that 4 lakhs of money in my pocket, but I get to put 6 lakhs into my NPS account or my ATC savings products. So the choice is yours. You want to spend 4 lakhs this year, or do you want to keep 6 lakhs away into your nest egg? It's crazy. This kind of, additional headroom to save up to 2 lakhs of tax outflow with that 4 lakh contribution, which effectively becomes 6 lakhs pre-tax, is crazy. Lisa, over to you.
I encourage everybody to actually look at this employer contribution, because we kind of overlook it often. We see our form 16 and everything, and we don't really go and ask like how much this year has been contributed by the employer. So have a look at it, and if there is that, if the entire thing is not taken up by EPF, then you have you have the room. You can go and then ask for the NPS contribution as well. And like you were saying, it's an automatic kind of saving also, and then you don't have to worry about your long-term savings. You're doing your EPF, you're doing your NPS. So go and check this amount and what it is, and whether there is that gap. And we often just don't do it because we see our own contribution, we see our taxable income. Acha, abhi hum kya kare? No, you have to see what your employer is also doing. I think to be mindful is something that's very important in this little bit.
Yes. All right, Pratibha. What else do we have? Are we through? Okay. Yeah, well, I don't know how many young people will relate to this slide, but maybe if you see your parents reflected here, and this is where you might be in 20 or 30 years from now. Yeah. Lisa, your department.
Sorry, yeah, sorry, sorry. I think so it's all in the numbers, and if you just see how money compounds. Compounding is basically you invest something, and obviously you get a return. You might get so the value of the investment going up, or you might get an interest paid out to you, or you might get a dividend, and you just put all that back and leave it, and it keeps. Then there is interest on interest, or earning as we call it, and that is your compounding. The simple math is that firstly you have to, compounding over the years can be extraordinary. And if you leave your money in, for example, for 30 years, which you can if you start at the age of 25, the amount you make in that 30 years, and if you just leave it for 5 more years, it doubles in that last 5 years. Not over the 30 years, in that last 5. And that is the advantage of compounding. Even if you take 1 lakh rupees, right? And I won't take a big figure, just take 1 lakh rupees, you leave it in at, I don't know, 10% for,
can I come in?
Yeah.
So I was fooling around with a spreadsheet this morning. So 1 lakh rupees saved over, so every year saved over 25 years. Okay.
Yeah.
You put away 25 lakh rupees. And even if it is compounding every year at 9.5%, that's the number which made the magic happen. Okay. So in 25 years, that 25 lakhs has become a crore. A crore. Okay. And the return I'm assuming is 9.5%. Of course, maybe we should moderate our returns in view of the lower interest rates now, but there was a time when 9.5 could be taken for granted, and we are pretty much close to, in equities, I think for the next 25 years, a double-digit return can, if it can't be assumed, it can be aspired for at least, right? And at 9.5%, hey, I'm going to get 4 times my money back, 4 times. And that too, I'm not putting it all now. I'm putting it in pieces over all these 25 years. Okay.
Yeah.
That's the power of compounding in small parts. That's the SIP and compounding magic put together.
Absolutely. And I think so that's one part, that, you know, the longer you give your money, the more it is going to work for you. The longer you just leave it in. And that's why, you know, some of, like, for example, the MPS structure works, because it really lets you leave your money. The other thing is that you have to also think about, you know, earlier fixed deposits, etc., were more in favor, and now we have market link products which can give you that little inflation plus edge. And compounding also can elevate your return experience in this case. So if you have a 5% return versus a 10%, over a 20-year period, the difference that you earn by that extra 5% is really 2.5 times. So what I'm saying is that, you know, you leave it in a fixed deposit for 5%, which is what your, you know, 5-year FD will give you now, 5.5%, versus a 9.5, 10%. You can earn 2.5 times more. So your product choice is important when you are doing your long-term, wealth creation and using your tax breaks for that. Your product choice is very important. Leaving it for the long period is also very important, which requires you to start early. And I keep saying it's so easy now. You can start with the smallest of amounts. You can start with a click of a button. So the excuses that you may have, that, you know, I didn't get time or I don't have money, those are not valid anymore.
None of that works. Yeah, I agree.
Yeah.
I agree. Yeah, so that's the thing. But I think this last slide is very, very interesting, and may not appeal to younger people right now, but you have no idea how valuable this input is.
So I'll make another point. So
yes,
I'll make another point here. What happens when we are young, you know, we feel that we are going to earn more and our earning will go up and we will be able to save more and we'll have, everything taken care of, which is a fair assessment. But what we don't count for is that you'll also have a family. You'll have children, you'll have your elderly parents, you'll have a home loan. Your expenses go up. One thinks of income going up. One doesn't really account for the expenses going up. There's no accounting done. Next job, I will earn this much more. Yes, that accounting is done. But next job, how much more are your expenses? Have you done that accounting? So you have to start saving early, because nobody does that. You know, we all think we'll earn more, but actually expenses. Children are expensive. I'm telling you.
Yes. So Pratibha, do we take questions? Are we at the end or is there more?
Yes, we can start taking questions.
Yeah, so I will not let go the chance to do a little bit of a pitch for the firm. Just come back to that slide. I want to tell people why they should be doing business with us. And for those who don't know, Lisa runs this wonderful personal wealth management or personal financial management site called Money.
Yeah.
So you should have mentioned that, Pratibha. That's the least we can do for Lisa today. We will mention it in the follow-through email for sure. So, you know, the reason you should do business with us is this. We are going to give you everything. All of this is available on a click. In fact, you can even open an account at it, you know, by just clicking through. You set up a single investment account. You can buy, sell, settle all your transactions in one click. NPS is available by clicking through on our website. We've got a completely digital solution for opting in for NPS. And of course, anything to do with investment, savings, financial planning solutions, all of that. We're a subsidiary of the bank you all love. And anything, all asset classes and investing products, equity, debt, mutual funds, commodities, currency, insurance, global investing. You want to invest in Facebook and Amazon, you can do it through us. And of course, NPS. Okay, questions?
So we have quite a lot of questions because we are almost running out of the time. I'll take a few questions here. We have a question from Rahul. He asked, hi experts, I'm 30 years old and a total annual income of INR 987K, 9.87 lakhs, and do not have much investment, but hate to invest in tax saving FD for 5 years lock-in, as I need some liquid funds every now and then. Is there a way or a product which is lesser than 5 years lock-in and also a safe tax? So I think.
Yeah, so the thing is, at an income of 10 lakh rupees or thereabouts, what is it that you need liquidity every now and then for? Okay, question your need for that liquidity. That's the first grandfatherly advice if I can give you. Do you really, really need that money? What are you putting it to use for? I mean, are you using it for gambling or what? I don't know. It could be for a noble purpose as well. It could be for a different thing which is required, which is essential, and so on. So it's always a question. The first tendency should be, can I avoid spending? You need to be a conjuice in life if you have to be a tax hacker, first of all. But you don't have to be a conjuice to the extent that you don't spend on essentials. Now, what is essential for you will vary from person to person, situation to situation. So that's contextual. The second bit is you want something to save for 3 years, bare minimum, and still save taxes. I think ELSS is the product for you. But be warned, it's a mutual fund. It's an equity mutual fund with 80% exposure to equities. So you can get a little bit of an up and down right there. But 3 years is good enough to make reasonable returns in the stock market. There can be exceptions, but I think it's a chance you should take. You should put away at least, and if you're employed and you've got this income anyway, you've got an EPF deduction of close to, I think about maybe, my rough sense is that 50-60,000 deduction headroom ATC वहीं पर मिल रहा होगा. And maybe you should put some money away into the PPF, another 20, 30, 50,000 every year in the PPF. And then the remaining 30, 40, 50,000, which will be liquid every 3 years, you can do that bit in ELSS. That works for you. Next question.
Question from Vijay Kumar.
No.
No, okay.
Yeah.
Go, Pratibha.
Question from Vijay Kumar. Dividend from mutual fund is taxable from next year onwards. Please correct me.
It's taxable from this year onwards. I mean, when I say this year, this financial year, which is why all you're seeing is a tax deducted at source in your dividend inflows, and you're not seeing the companies paying dividend distribution tax anymore. Correct me if I'm wrong, Lisa.
No, it's applicable from this year, and it's quite a tax. So I think in mutual funds, I don't know which mutual funds you're investing in, but better to avoid that tax. And
yeah, so better to avoid taking dividend schemes anymore, because they'll just add to your tax outflows. It doesn't make sense.
Growth option is good enough. Capital gains tax are much more efficient as compared to the dividend tax.
Yes. Okay, Pratibha.
Hi, what happens about 7.5 lakhs? Havesh is asking how much is it taxable, 10% or more? I think this question pertains to NPS. So he's asking if my investment exceeds 7,50,000, what happens?
So you get the tax benefit up to 7.5 lakhs, but you can make your own personal contribution beyond that as well, right, Pratibha? Nobody's stopping you from investing in NPS. It's just that the tax benefits are available to up to the cap of 7.5 lakhs. I think it's a good idea to go beyond the tax benefits. Of course, NPS is a lovely product if you're young, you want to compound longer.
Yeah, so basically till 7.5 lakhs, you get the tax exemption, and any income beyond that, even if you invest it, you will be taxed at your rate of income tax, whatever is.
Yeah.
How to take contribution in NPS to 7,50,000? Employers allow only 10% of basic.
No, they don't. That's the bare minimum that they can do under the existing framework, which is there up to the 1.5 lakh limit or the 2 lakh limit and so on. Speak to your employer and get a larger amount deducted every month. So you have your December, Jan, Feb, March salary, and figure out if you want to avail of 4 lakh rupees additional benefit, then tell them to deduct 1 more lakh from your salary account every month for the next 4 months. Simple.
Yeah, I think ask for the details. Ask for the details. See what your employer is contributing, and see where the gap is. You'll figure it out.
There's no employer which will not do this on your request. They may be doing something by default. That doesn't mean that your request is not welcome or that it can't be implemented. Okay.
Yes. Yes.
All right.
Vishal is asking your suggestions. What do you suggest to invest in a short-term plan for 3 years, 4 years, and 5 years?
So, you know, this 3, 4, and 5 years is not as different as you might think. For a saver and a tax hacker, 3 years is no different from 5 years in character. There is a numerical difference, of course. But I think the character, so this is Prashant, right? So Prashant,
Vishal.
the character that, sorry?
Vishal.
Okay, so, right. So the character required to be a tax hacker is to think 10 years, 15 years, and 20 years, and even more, 30 years. And the options for saving money over 3 years are obviously ELSS. That's the shortest tenure. And you need not withdraw that money after 3 years in any case, but you do get a 1 lakh rupee, up to a 1 lakh rupee income break if you withdraw after 3 years, and then you can reinvest that money into another ELSS if you want to, if that's all that is bugging you, and if you want that liquidity. But I don't think we are today discussing situations on how to save taxes or how to find tax hacking instruments for 3 and 5 years. We are discussing and we are zeroing in and making you more aware of the virtues of long-term compounding, of the virtues of upfront tax savings that long-term compounding avenues such as EPF, PPF, and most of all NPS allow you, and the very low cost of fund management at NPS. Okay, so 3, 5 years is small stuff. Let's not sweat the small change here. Okay, the big picture is, of course, saving for 20, 30 years.
Venkatesh makes a comment here. He says, nice quote by Lisa, children are expensive. Don't want to like it, but agree that it's a hard fact.
So let me come to Lisa's points here. I'm sure she's capable of defending herself, but you know, it's not just children who are an expense. It is we who are the real expense, and it is our choices of that we make for having our children and for deciding many things for our children, and not to mention parents here. So we also take, as we move forward in life, we realize that we take many decisions on behalf of our parents, who gradually begin to fade away from the decision-making role in the family. And then we become parents, and then eventually some of us will become grandparents. And that's the life cycle that we want to make you aware of. You're not going to be young forever. You're not going to be 20-something forever. You're not going to be 30-something forever or 40-something. You'll be 70-something someday. Lisa, how does that sound?
So with this,
so I'll just say, you know, one thing that the comment was not so much in isolation. It was more to say that when we are younger, we don't account for that expense. And it does, you know, having a family is something that everybody wants to do, and it's great, but it does come with its expenses, and one should think about it and plan for it. I think that was the main point. But you're absolutely right. You can go as far as you want with the, you know, how much you allocate to all these things versus how much you don't.
Right.
Some stage in all our lives, we'll be in a sandwich where we have our parents and we have our children. And like you said, we are doing the decision making for both ends. So these are things that one doesn't think of when one is 25, but this is the reality that hits you 10 years later. So might as well plan for it.
Okay, next.
Yes. So with this, I come to the last question here from Meenakshi. She's asking, NPS voluntary contributions gives an additional 50,000 exemption. Also presented 2 more options. What is the tax benefit in those options? I wasn't unable to me.
Pratibha, I lost you for most of that question. I don't know if Lisa heard it well.
No, it was, I think there's something wrong with her connection because it was not very clear.
Okay, Pratibha, you'll have to give it another shot.
Can you hear me now?
Perfectly.
Yes, so we have a last question from Ms. Meenakshi. She is asking, NPS voluntary contribution gives an additional 50,000 exemption. You also presented 2 more options. what is the tax benefit on these options? It wasn't clear to me. So I think we will have to re-explain that.
Okay. So if the 50,000 additional headroom is not available on voluntary contribution, it's there on the employer contribution, which you have to tell your employer to make through your corporate account that you have with NPS, right, Pratibha? Your voluntary
Yes.
contributions do not qualify for tax savings at all. These are just separate savings that you're running, and you can. Yes.
If we go back to the slide, Shyam, if you can help us going back to that slide, voluntary contribution, there is no, in any contribution for that matter, there is no upper cap in making the contributions.
Right.
The capping is made on the tax benefits. So if you are making a voluntary contribution, it is capped to an extent of 50,000 per annum.
Okay.
Whereas when we are talking about an employer contribution, that is capped to a value of 7,50,000, which happens to be an aggregate of your EPF, NPS, and superannuation.
Okay, so just come to that tax saving slide again. I think we are jumping across too many slides here. The one
with the star. Yeah.
Have to move that a bit.
Slide number 11.
We're moving forward.
Yes, 2, 3 more to go.
Yeah.
Yes.
Okay. So this is the one. Yeah. So you've taken that 1.5 lakh umbrella benefit. Some of it, maybe 20,000 comes from NPS or something. Why don't you maximize this slide, Shyam? Okay. And so you've taken that benefit, and yeah, not that one. There's an icon on the lower right hand side that you will have to use. Yeah, this is perfect. Yeah, we're getting there. This is the one. Yeah, super. So you can go beyond that 80 CCD and put in another 50,000, and then you can get your employer to contribute over and above the 80C and go to 80 CCD2, and you can drag this up all the way to 7.5 lakhs. So what's difficult to understand here? I don't get it. It's up to you. You pull the levers. You can get the tax benefit. Okay. So you put in 50,000 on your own, but you can also get your employer to deduct that much money from your take-home salary and put it into the NPS account. If you want to do that for this financial year, you can choose to do that spread across 4 monthly payments: December, Jan, Feb, March, and we are good to go. Any more questions, Pratibha, or are we through?
We are through here, Dipen, and with this, I thank you, and I thank Lisa for taking out time on a Saturday and joining us and sharing your insights on Tax Hacks 2020. Message to the audience: we will share the recording link and this presentation with you over the email, along with the process notes and links on how you want to open an account and all, and a link to Lisa's website, moneypuzzle.in, so you can go there, hover around, and see what suits you the best.
Okay, Lisa, we'll let you have the last word.
Thanks a lot. My pleasure. Doing this this Saturday afternoon, and to share a little bit of the experience that I've had. And like I said, the topic for the day was the most important thing, that you have to create wealth while saving tax, and one has to remember that.
Okay, bye.
See you. Thank you. Bye.
Bye.